Hi, I'm Myles, founder and CEO here at Flying Colours. Our videos discuss themes that matter to you when investing your money. Today we'll look at the alternative investment market, or AIM, and is it worth investing in? Many UK investors are aware of AIM-listed stocks and wonder whether it might be a good place for them to invest. In addition, there's been a lot of change in the AIM market over the last few years from both an investment and tax perspective. So let's take a closer look. The alternative investment market, or AIM, is a subset of the London Stock Exchange. Companies listed there are smaller than those listed on the main exchange. They are usually worth between 10 million and 1 billion. The AIM market's purpose is to help these smaller companies access capital by listing on a public exchange, but with greater regulatory flexibility than the main LSE stock market. However, recent returns from AIM have been disappointing. In mid-March 2024, the AIM index peaked at almost 4,000, before going on to steadily decline to today's value at about 3,300. And over the last 5 years, AIM performance has been broadly flat, while the FTSE 100 is up by over 60%. Some of this can be explained by a loss of confidence in the market from companies. The number of companies listed on AIM has fallen from 1,700 in 2007 to only 679 today. And the average market value of listed companies is now only 72 million. The annual cost of being listed on the AIM index is around £500,000, which is a significant amount for a small company to find. And for investors, the dividend yield on AIM, which I think is a reasonable measure of value, is only 2.2% compared to 3.6% for the FTSE 100. So it's hard to make a compelling case for AIM based on valuation compared to other assets listed elsewhere in the UK. There are reasons to be positive, however. AIM has always been a stock picker's market, and it's likely that experienced fund managers can produce returns that are ahead of the overall market. This is one of the areas where I would always suggest finding an active manager able to do this. There is also a chance that the UK government will make efforts to reinvigorate AIM to improve the country's economic performance. They may look to achieve this by providing support for innovative companies which tend to be listed on markets like AIM. This could make a difference to returns, but it's probably best to wait and see. One area of interest for AIM has been the opportunity to reduce your inheritance tax bill. AIM-listed shares qualify for business relief, and holdings are therefore exempt from inheritance tax after a holding period of only 2 years. AIM-listed shares are also eligible to be held within ISAs. Combining business relief with the ISA tax wrapper has been popular with investors who want to reduce the risk of an inheritance tax bill. But the last autumn budget announced changes to inheritance tax relief from AIM shares. From April 2026, AIM now only offers a 50% exemption. The effective inheritance tax rate becomes 20% rather than 0. This makes AIM shares less effective than other forms of business relief. To summarise, given the difficult background to AIM, limited investor interest and high costs, it's hard to make a case for it as an effective investment. This may change, but we would rather wait and react to what happens. If you have any questions about today's video, please get in touch. Just email me at hello@fcadvice.co.uk. Finally, as ever, I've been talking about investing, which means that your capital is at risk. Thank you for watching.